Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. How to avoid getting your loan application declined. One of the most frustrating things that could happen to a home buyer is getting your application for finance declined. By this stage, you've already likely been to dozens of open homes, organized all your paperwork, and potentially even put in an offer on the property that you're interested in. Falling over at the last hurdle is not only frustrating, but it can also make you feel like your dreams are over. But they don't have to be. And more importantly, there are a few things that you can do to make sure your loan application doesn't get declined. So in this episode and this podcast, I'll be discussing a few items and a few factors that you may like to consider in strengthening your application as well as your offer. So firstly, borrowing amount. The more you're looking to borrow from a lender, the more risk it presents to them. If you want to borrow more than 95%, that can be a red flag for the lender. Most banks like to see you come up with at least a 20% deposit, which means an 80% loan to value ratio, or LVR. While this might not be possible, there are options available that you can take and look at to consider a higher LVR, and this involves, or a higher borrowing amount, and this involves paying something that's called lender's mortgage insurance, or LMI. If you do need to borrow with a higher LVR and only have a small deposit, you might want to look at a guarantor loan, such as a family pledge, or even taking advantage of a government program such as the First Home Loan Deposit Scheme or First Home Buyers Assistance Scheme. Secondly, stable employment. In a perfect world, when you can apply for a loan, the lender would like to see that you've got a long-term stable job with a regular paycheck. Unfortunately, things are not always that simple, and these days many people have very unique work situations. If you're self-employed, for example, or haven't been in your current job for at least 6 months, then lenders might not look favorably on your application. Fortunately, there are lenders that understand your situation, and therefore it is important that you work with a mortgage broker who can match your employment situation with the right lender and lender policy. If you're unemployed, you're going to have a very tough time getting finance of any kind. These days, even if you're asset rich, you still need to be able to show how you intend to service the debt. Now, of course, this takes into a wide consideration of, say, low doc, lease incomes, regular PAYG pay slips, perhaps you're self-employed and receive director's fees or dividends from the company. So talking to a mortgage broker to discuss the combination of servicing and employment or ties to companies in Australia, for example, this is something that's going to be of importance, especially say if you're an expat, or if perhaps you've just set up a company and you're, one day GST registered with an ABN, and, stuff like this can be important because obviously with stable employment, we're looking over nearly a 30-year time horizon. So the lender's got to have some confidence in your ability to derive a stable income. Thirdly, credit history. Having bad credit is often a red flag to a lender, and it is not always one that is easy to overcome. If there is an error that has been made on your credit file, then that is something you can definitely sort out through a credit agency. However, if you've been bankrupt in the past, or perhaps you've defaulted on a loan, you might need to work with a specialist lender. So say, for example, you've missed a phone bill that's valued at less than $100, maybe this is something that some lenders can work around. Similarly, if you've got you've missed a couple of repayments for between $100 and less than $1,000, then obviously your types of lenders that you can qualify for are shift over into the specialist and near prime range. And like we mentioned, if you're bankrupt or perhaps you have tax debts or whatever it may be, these can definitely affect the type of lenders that you're eligible for. Fourth, spending habits. Banks and lenders like to see that you're able to manage money effectively. If your spending habits aren't great, then that's likely to be a sign that you might not be able to manage a mortgage. Putting together a few months where you keep your spending habits under control is important, but it's also more important to not have a host of debts that you need to be paying each month, such as car payments or personal loans, for example. Lenders do not look favorably on these types of costs as they are fixed, recurring costs, unlike your discretionary monthly spending. So what that means is that when you submit a home loan application, you may be required to submit daily transaction statements to verify your living expenses to determine whether or not your commitments and your income generation are suitable to servicing a loan. And from this, the lender may notice that perhaps you've got certain recurring subscription expenses or regular payments on your credit cards or other debts, and this may be a turnoff for some lenders. Similarly, they may notice, say, some discretionary type of spending, such as buy now, pay later type of schemes, alcohol expenses, gambling expenses. These types of discretionary things are obviously, each person has their own lifestyle, but obviously some lenders do like having a certain profile of borrower that is available, and that's where you see those types of loan products where lenders are advertising for a certain rate or perhaps a certain loan amount, and they have or a certain credit profile, and they have a certain idea of who they want. So not everyone will qualify for every single loan product available, and not every borrower needs to be eligible for every single loan product. Having a diversity of loan products available that your mortgage broker can direct you to is important in making sure you get the best outcome that meets your interests and your financial goals. Next, buying an unusual property. If you're looking to buy a property that might be tricky to sell in the future, banks won't like the look of it or look favorably towards it. That might mean a holiday home or even a rural block of land. Banks will always consider the worst case scenario, and if they need to sell the property because you can't make the repayments, they want something that will be able to sell quickly and easily. So, in a loan application, a valuation report may be required, and on the report, the valuer will note market attractiveness, resale capability, market value, market rent, etc. And it's important to make note of this because if, for example, the valuation report comes back as saying something along the lines of, this property at so-and-so address is relatively unattractive to the market due to, say, an easement condition on it, or perhaps it's environmentally contaminated, something like that. This may pose a security risk or a collateral risk to the lender, and if, say, you default on the loan, this would mean that the lender would have to hold this asset or this security without any chance of, or without the likely possibility of it being able to be sold later on to clear your debts. And so this essentially poses a risk for the lender because they have to hold this asset on the books without being able to generate any returns off it. And lastly, get pre-approved. To avoid getting into the situation where you might get declined, it's vital that you go and speak with a mortgage broker before you even start looking for properties. That way, they'll be able to assess your personal situation and also give you some guidance around the types of properties that you're going to be able to afford. So, for example, this can take anywhere between 1 and 2 weeks to do a fact find and perhaps even get a pre-approval with some lenders. So it's important that, again, you don't want to be waiting to get your finance up to the last date. It's important to be proactive and, again, be organized so that you can figure out over the course of, say, a couple of months, that if you, say, need to organize your finance, you at least can have options and multiple routes of getting the finance you need, whether that be through full doc prime regulated lending to specialist low doc lending. So within that spectrum of loan products and lenders, your mortgage broker can help you navigate those options to help you find a product and get you the finance that you need. And that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.